It's springtime in Florida, and the golfers are out in force. Golfers tell you that they love the challenge, they love being outdoors, they love the relaxed pace golf offers. Well, if you need an excuse to hit the links, you can let folks know that while golf and investing might seem like very different activities, they share a lot of similarities. And if you can improve at golf, you can improve your investing. So today we're going to cover 10 ways that golf improves your investment return. Number one, it takes time to become skilled. Becoming a good golfer requires a lot of effort and a lot of time, and I'm a terrible golfer because I don't spend enough time on the course. Becoming a skilled investor takes a lot of time and a lot of effort. And unless you're willing to devote the same amount of effort to learning about investments as you are to your golf game, it's going to be very difficult to become a skilled investor. Number two, both require expert instruction to reach your potential. Even the best golfers, the Tiger Woods, the Mickelsons, they all have coaches. You might not hire a coach for investments, but you can hit the bell icon, subscribe here, purchase books and access other sources of information, and get the coaching you need to make yourself a better investor. Just like you can go here online and find folks who can help you with your golf swing. Number three, it's easy to have a great game go bad quickly. One shot into the water, or a few shots into the water, or out of bounds can really ruin a perfect game. One clunker investment will not destroy your portfolio if you're properly diversified, but it can come close if you don't handle the mistake quickly and properly. Number four, it's important to control your thoughts because emotion can make you make very poor decisions. Going for the long drive to show off versus giving a two-stroke gimme layup shot can completely screw up your golf game, especially if your golf game's like mine. Almost all investors have made at least one terrible financial decision based upon pure emotion. And so if you let emotion get in the way of good analysis, whether that's to buy or to sell, you can end up really ruining your game. Number five, patience pays off. Rushed decisions are often really bad decisions. Take the time necessary to make a good decision. Research what you're going to do. Take a look at that shot. Make sure you've got your distance. Make sure you know where you're going. Rushing a golf shot rarely works out well. Jumping to conclusions about an investment is going to lead to similar results. Number six, sophisticated tools aren't the answer. As you can tell by looking at my 15-year-old Callaway here, golf technology improves by leaps and bounds every year. Courses that used to hold professional tournaments years ago are way too short now to accommodate the better clubs and balls that we have today. However, the average golfer, or below average golfer, doesn't really improve their score all that much with all that advanced technology. Some folks, some of my friends, they buy new drivers every year based upon how Big Bertha got this year. My Big Bertha is kind of getting a little bit worn in the tooth, but that's okay because I'm not that good. And those guys ain't getting much better by buying a new club every year, but they like the advanced technology. They think it's giving them an advantage. What it's really doing is hitting them in the pocketbook pretty hard every year. Investing theories, tools, software, the subscriptions you can make, they get more sophisticated every year too. And you could spend a fortune on subscriptions. You could spend a fortune on analysis tools and the gurus that can tell you here's where to put your money in order to make great returns over the next 60 days. And a lot of times you'll never make the ROI in time or money to justify it. You're looking to beat the market, and you've got big investment banks that are out there doing the exact same thing, where folks are devoting all of their time, energy, and effort and millions of dollars in tools to be able to answer those same questions. So sophisticated tools aren't the answer for golf, and they're not the answer for investments either. Number 7, one great game doesn't make you great. One great shot doesn't mean you're a great golfer. One horrible game doesn't mean you're suddenly a horrible golfer. Any of us who know golf know that those occasional amazing shots are what keep us coming back to the game. And the horrible shots can really bum you out, especially if you've put a few good shots along the way and then you end up shanking one into the pond. Just because a stock has gone up tenfold for the last several years, and you picked it, and you're like, yeah, man, I can pick winners. I'm consistent. I'm a great stock picker. Doesn't mean that it's going to go even higher. Doesn't mean that it can't crater, and doesn't mean that your next pick is going to be a good pick. So do your homework and measure your performance, and measure the performance of investments as well as investment managers over the long haul. Your average in golf, your handicap, is going to derive the view of how good a golfer you are, and your long-term return on your investments will determine how good an investor you are. Number 8, it's all about risk management. The best golfers are really great about hitting the ball, staying cool, managing risk on the course. I'm famous on my golf game, not for my drive, because my drive is terrible, but in my short and intermediate game, I'll do a couple shots up the fairway, keep everything in play, and be able to play a very relaxed but very safe game because I'm managing risk. It's not always easy to decide whether to do that layup or go for the flag, particularly when you got guys who, let the big dog eat and just let it go. But what I found is playing it safe and running straight down the fairway is going to, over time, provide me with the best average, the lowest handicap, and best return. Risk assessment and risk management are significant parts of investing too, and knowing kind of whether it makes sense to take that flyer based upon how the rest of your game is going or how the rest of your investments are going, or whether you should be just hitting safe ball down the fairway, will make a big difference. And so it's all about risk management. Number 9, the casual advice you receive on the course, or the casual advice you receive from your friends, is frequently bad advice. Every golfer has a friend or a stranger or a playing companion that want to provide you with advice on your swing, on your equipment, on your stance. And normally it's not good advice because they're not a professional coach. They're just giving what they see. Casual investing advice is just about as useful. If you're going to take advice, or if you're going to take coaching, make sure you take it from a real expert, someone who's been there, done that, gone through ups and downs, and isn't just a fly-by-night man. And I've made it. I've had a couple good games, or I've had a couple good investments, so I can tell you how to get yourself rich, because they ain't going to do it. Number 10, know where you want to go. If you don't know where you're going, you might not ever end up there. Every shot on the golf course requires a target. Every approach to every hole requires a plan. You're going to know before you pull the club out of your bag what the distance you're trying to go is, what the target you're trying to reach is, and how many shots you're going to take to get that ball in the hole. The target's chosen because of the obstacles on the course and the location of the hole. Your investing must have a target as well, and you need to develop and specify those investing goals. Is this a flyer? Is this one that I'm going to, kind of have some fun with? Or is this a core component of my portfolio that I should be playing a little bit safer to run down the fairway? So, while you might not think golf and investing have much in common, they actually share a lot of similarities. If you're a good golfer, you can become a good investor by applying some of those same principles. And if you're a good investor, you might not become a good golfer. I'm kind of proof positive of that, unless you're willing to put that time in on the course. The same ideas that allow a golfer to become great can allow an investor to become great. Planning, patience, expert instruction are great ways to improve your golf success and improve your investing success. So, want to up your finance game as well as your golf game? Time to hit the links.